Let's now get across the market open. Matt Schwartz joining us from Lincoln Indicators. Matt, welcome back to you. Another big night, certainly with a focus on Wall Street, which rallied ahead of the Nvidia result, and it failed to disappoint.
Yeah, it certainly did fail to disappoint. It has been, I guess, a slower start to the week in the US, but overnight, obviously, markets lifted by some more trade or Trump rhetoric around the Iran conflict, and the S&P 500 rallied in turn up 1%. The Nasdaq index up 1.5%, and small caps did lead the charge overnight with the Russell up 2.6%, with Brit being pretty strong. 70% of constituents in the S&P 500 were up overnight. And if we sort of unpack that a little, Andrew, it was the beaten up cyclicals like autos and consumer stocks were the best performing on the back of the fact that oil prices were down 5% and clearly bond yields retreated, which was a big positive for the cyclicals. Underneath the surface, as you called out, Nvidia result was preempted and that the semis were strong. Semiconductor stocks were strong, as were the software stocks, which have had or staged somewhat of a mini rally in recent days.
Just breaking down that Nvidia result a little more there, Matt. Obviously, it did beat expectations for revenue forecasts. What do you make of that, and to whether you think this momentum we're seeing in those AI-related trades are likely to continue?
Yeah, look, the result overnight numerically was an extremely strong beat once again. Revenue up some 85% year on year, and guidance, which was the important part, I guess, was ahead of expectations. But I think the really important part of the result was its gross margins. So going into the print, investors were somewhat concerned that the transition to the new Blackwell platform could pressure its profitability somewhat, because these systems are clearly somewhat more complex. But Nvidia did hold its margins at about 75%, which is a terrific result and does, I guess, demonstrate their tremendous pricing power, despite all these existing supply chain complexities. So for the AI bulls, I think the key takeaway is that AI infrastructure demand still appears to be extremely red hot, which will likely lead to continued support for the broader AI infrastructure names, including your semis, your data center stocks, network hardware, and power infrastructures, which has really been, I guess, the area of the market that investors have flocked towards and have probably created this environment where the S&P 500 looks a little better than the reality of this year.
Meanwhile, the market's certainly getting excited about IPOs to come, SpaceX among them, as well as OpenAI.
Yeah, so OpenAI aside, I think what caught my attention after market again was the announcement that SpaceX have filed their sort of prospectus or IPOs to the SEC, which is indicating that they're not far away from road showing that float. And within SpaceX, which sort of merged with XAI, you've got SpaceX, Starlink's X, which is the former Twitter, Grok, etc. But we're looking at an eye-watering multiple and a valuation of some 1.25 trillion, which will break all records, I think, for any IPO in history.
Now, meanwhile, Matt, obviously seeing this AI disruption, and that is causing continued dislocation in the jobs market. The latest firm to announce job cuts being Intuit.
Yeah, so that again just follows the same sort of thematic around AI and job destruction, and that's certainly been most prevalent in that software space. And Intuit followed in turn last night with announcing a 17% headcount reduction. I think Meta also plans to lay off about 8,000 people, and that comes hot off the heels of other announcements throughout the month, with Cloudflare announcing 20% trim to headcount, and even Cisco Systems announcing headcount reductions. So, quite clearly there's AI winners and losers, but, from a software standpoint, it does appear as though these businesses are looking to, I guess, compensate for potential gross margin decay by improving their operating margins by reducing headcount. And we've seen that as well in the Aussie market as well, haven't we, with WiseTech announcing significant headcount reduction, Block, Atlassian. We've seen it with Premium. There's been a whole bunch of stocks that have followed this particular trend.
Indeed. Matt, just looking ahead for our market today, when in fact we saw what happened overnight, oil prices, they were down about 6%, in fact. on that news, President Trump once again saying they're very close to a deal. That certainly got the market excited, pushing oil lower. But that's sort of unsubstantiated claims at this point, isn't it?
Once again, I kind of it defies belief sometimes that the market reacts to the rhetoric, and clearly Trump's projecting here. I think he's clearly looking for that off ramp and looking to sort of declare a victory. And I think what took the market's attention last night was he said, at least, that they were in the final stages of a deal. No confirmation from the Iranian side at this point, and we've seen this all before. We'll have a look at the trading activity pre his announcement today to see whether there was any large trades preempting this particular announcement that he made. But how many times have we seen this over the course of the last 6 weeks? There's been many times, and it's created huge volatility in oil markets and also in bond yields as well, which dropped substantially overnight, about 10 basis points.
Now, Matt, on the local market, we're getting whiplash at the moment, given one day we're up, the next day we're down. Today we're up. We're looking at SPI futures up around 1.25%, so obviously expecting to rally. What are you seeing on the local market at the moment?
Look, it's been quite weak. On a month rolling basis, we're down about 5%. So, my sort of takeaway is that Aussie investors are behaving, somewhat more rationally, and what we've, underneath the surface, I guess, from the broader indices, defensives have outperformed cyclicals, which is what you'd expect when, what we're observing in the market and in the economy at the moment is, cost of living pressures and inflation, which has led to, a number of downgrades in that cyclical space, particularly those that are concentrated to the consumer. So it's been a big confession period and a lot larger than in previous cycles.
Any particular stocks on the move at the moment? Obviously, we've had more downgrades. You're sort of looking at changing your portfolio positioning at this point?
No, not necessarily. I think we're sort of positioned neutrally, and it really is a difficult environment to actively manage a portfolio, just sort of given how volatile the environment is, and the fact that the economy is under pressure is a direct consequence of this war in Iran, and it's anyone's guess as to how this plays out. The market's obviously priced in this risk, and our portfolios are more concentrated in the quality side of the market. So we continue to sort of hold that bias to quality companies with some growth potential. This week, from our portfolio context-wise, Technology One delivered their result. We were really pleased with that outcome, and although the market didn't react all that favourably on day one yesterday, after the analysts had time to digest the result, I think the market's pretty pleased with the future direction of that business. And the software stocks have been pretty much blown up this year, but I think over the next 6 months we're really it's going to be far more selective, I think, in that space, and those businesses that can demonstrate that they can use AI to their benefit, which Technology One certainly have made some good progress there with their Plus module, having an exceptionally good take-up rate amongst their clients. We think that holds them in good stead to get a good multiple re-rating.